right, we begin in Nigeria. The Central Bank of Nigeria's Monetary Policy Committee unanimously decided to raise its benchmark interest rate, also known as the monetary policy rate, from 14% to 15.5%. This is the Apex Bank's third move in 2022 in response to inflation's upward trend. Boason Omofaye, governor of the Central Bank, revealed this while reading the communique from the final meeting of the Monetary Policy Committee for the year. The Central Bank hiked the interest rate from 11.5% to 14% in the two sessions since the last MPC meeting. But with the inflation rate still running above 20%, CBN has boosted the rate even more to 15.5% in an effort to counteract the rising cost of goods and services.
The committee thus agreed unanimously to raise the policy rate, to narrow the negative real interest rate and narrow the interest rate gap, and rein in inflation. Committee thus voted unanimously to raise the MPR. 10 members voted to raise the MPR by 150 basis points, 1 by 100 basis points, and 1 by 50 basis points. 10 members voted to increase CRR by 500 basis points, while 2 members voted to increase it by 750 basis points. In summary, the MPC voted to 1. Raise the MPR to 15.5%, retain the asymmetric corridor at plus 100 and minus 700 basis points around the MPR, increase the cash reserve requirement ratio, CRR, to a minimum of 32.5%, and 4, retain the liquidity ratio.
All right, joining us to discuss further, we're joined by Arise business analyst Bode Ososami, Arise Xchange anchor business correspondent Boason Omofaye, and Damilola Akinbami, senior manager clients and industries at Deloitte. Good afternoon to you all. Thank you so much for joining us. So I want to get reactions to what we've just seen. Dami, let's start with you. What do you make of this MPC decision?
Yes, good afternoon, Rotus, and thank you for having me. Well, the MPC's increase in interest rate was expected. I mean, most analysts expected that there will be an increase in the MPR. If at all, it was the CRL increase that was the twist in this decision. So it just shows you that definitely, I mean, the central bank is taking its price stability mandate really seriously, and is getting more aggressive in addressing the rising inflationary pressure that we've been seeing occur in the country in the past couple of months. But this particular stance, definitely what we're going to see is a further spike in interest rates, because with this, both with the increase in the monetary policy rate and in the cash reserve requirement of banks, there's going to be a squeeze, a tightness in liquidity. So we're going to definitely see interest rates increase further, which is good news for, I mean, fixed income securities, but the equities market will definitely take a beating. So the CBN, what the CBN has done basically is to address predominantly the demand pull side of inflation. But bear in mind, in Nigeria, there's that demand pull inflation factors, but what is driving inflation in Nigeria is more cost push and supply shocks driven. So a lot of analysts are thinking right now, so this further increase in interest rate, is it sufficient enough to address the fundamental issues driving inflation in Nigeria? And also the CBN, in a way, has used this increase to actually address the exchange rate issues, the currency weakness we've been seeing. Bear in mind, I mentioned that one of the things we would see is tightness in liquidity in the system. So the banks definitely are going to be squeezed further. And bear in mind, the CBN has said that, I mean, these debits are going to hit by Thursday. So he has given the banks till Thursday to fund their positions before the 32.5% CRR rate would kick in. So there's going to be a tightness in liquidity. So if there's a tightness in naira liquidity, the CBN by that is trying to also address the demand for forex in the market.
Thank you so much for that. Dami, Boason, please, what's your thoughts on what we've just seen with respect to this rate?
Yeah, interesting. Damilola got it right. Look, the central bank is trying to take naira out of under pressure. Look at the whole exchange rate conundrum in Ghana, for example, with the CD running underwater, as it were. So you need the central bank is trying to do everything possible without putting a bit further pressure on the fiscal authorities to raise money. Ghana is looking for $3 billion right now. Egypt is also talking to the IMF. That could be concluded, according to the Minister of Finance, within the next 1 month or two. So there are pressures around a number of sovereigns around Africa, including South Africa, to balance the books, as it were. Deficit is running, subsidies is running on agriculture and fertilizer on a number of areas. The economy is bleeding, no thanks to the pandemic and no thanks to the war in Ukraine. So every sovereign is seriously under pressure right now. And the dollar is back on its throne. So, and it's just brushing every currency aside. Everybody's flying to safety, whatever you can. So emerging markets our frontier markets like Nigeria would continue to be under pressure. The central bank needs to see less currency naira in the market, which is not going into productive activities, which will be going into politicking. And I think the central bank has just shut the political circuit. Campaign is just starting official, I guess, tomorrow.
Yes.
So the central bank came, this is the night of the long knives. The central bank just pulled the rug under the politicians, as it were, and said, look, move all the cash in the banks. Move it now into my vault. I don't want to see any banks with any excess naira before they start distributing money. Some folks are already printing money, by the way, printing cards to distribute money. So the central bank just served the backhand to the political class this afternoon so that there will be less naira. Because again, you're going to run inflation between now and the end of the year into the start of next year. The whole budget for 2023 is going to be dislocated if you allow so much currency in circulation, which is not going into productive sectors. So before the banks start moving bullions, bullion vans. Again, for politicians or whatever, let me get them into my vault where I can have a bit of control. Then I'm not going to pay you so much for it. So I'm going to warehouse, I'm going to sterilize this money. So the CRR, I didn't see this coming. Everybody I spoke to were thinking, well, okay, maybe 50 basis points, not 150. So it's like this is nailing the last nail, as it were. I think the central bank in November, December, will likely stay a little bit dovish. I think this 150 should be the last for the year, as it were. I think the central bank is going to wait at the last MPC meeting for the year to see the effect of what has been done now. Because again, this is hit the political wrong. The spending for the end of the year is going to constrain consumer spending for the end of the year. Folks who are looking for Christmas, New Year, and what have you. This is not good news at all, as it were. But again, inflation has become so stubborn that something has to be done about it. But it looks like every central bank is chasing the same thing. But some folks said when we were doing all the quantitative easing and we're doing asset bond buying and all of that in 2021, they were going to run into this crisis, and here we are. We're finding ourselves fighting inflation.
The
gloves are off.
The gloves are off.
The gloves are off.
Completely off. He's thrown them off. Bode, please, what's your take on what the decision we've seen here?
Well, definitely it was a bit of a surprise because, just like Boason said, nobody expected 150 basis points. The most I'd heard was 100, and I hadn't heard any analyst think we'd go that far. And of course, to go into CRR again means it's all out war on inflation. But I think what the central bank also emphasized, which is very important, is the negative interest rates, negative real interest rates, which is a red flag for investment. And clearly that has to be addressed, especially in the context of a more hawkish Fed, where you're seeing capital outflows and many are recalibrating their risk return considerations. You won't get away with negative interest rates if you want to get some FDI coming into your jurisdiction. So they had to address it, but it was a very bold move. And the other concern I had, there was a chart that I said, I don't know whether Lillian has it, on growth. There was a concern I had that the central bank seems to be sweeping the growth issue, saying it's not so important, we're there. But I don't think we are really there. Although they forecast 3.2 thereabouts in inflation, growth, that's the GDP rate. If you compare where we are as far as growth is concerned with other economies that we really should be matching, we're really nowhere. 3.25. So given where we used to be, but we really need to be doing like 5%. I think even 7%, like countries like Vietnam and Indonesia, to be able to dent the unemployment. Unfortunately, we don't get unemployment data to understand how important it is to move the needle as far as growth is concerned. Of course, a lot more has to be done on the fiscal side to address that. Which is not exactly the central bank remit. But I think that the point I want to raise is much more attention needs to be given to the economy to get it to be growing at least 5%, essentially to get unemployment to where it needs to be, to get also poverty levels down. These are the things that really matter. This, yes, it is going to address some of the issues around FDI, getting investments in, especially when you have the real rates coming down. But in terms of economic growth, of course, we know what the impact of raising interest rates is going to mean on growth. There's going to be a downward pressure. And unless you have something on the fiscal side offsetting that downward pressure, I'm concerned that if we do see a recession, as many as we are likely to see towards early January next year, oil prices definitely are going to keep going further down. And you also know what that means. We should be prepared for many of those things. And I think the central bank should be more future-looking, more forward-looking to see that we are not exactly ready for the next year.
Thank you so much for that. All right, everyone has already touched on the CRR surprise, but let's listen to the governor of the central bank where he actually answered a question on CRR and the reason why it was increased.
We have increased the CRR, and we expect that this decision at this meeting must be seen to be potent and must achieve the effect that the MPC thinks it should achieve. This message is meant to underscore the fact that MPC says this decision, this very aggressive decision to rein in inflation must yield result. We do not want to face Nigerians in the next few months and we begin to take the blame for not being able to rein in inflation in spite of all the rates that we have raised. So we have decided to adopt a two-pronged approach. Increase NPR, so policy rates, so we want to see interest rate go up. And two, CRR going up because we must mop liquidity effectively out of the vaults of the banks.
All right, so Dami, I mean, you already kind of alluded to this in your first answer when we had you. But again, just reacting to what the central bank governor just said, the fact that he's mentioned, we have to clamp down on liquidity. With respect to where we see things, do you think this addresses, I guess, the part of the issues, I guess, that we're seeing in the country right now?
So like you rightly mentioned, when I answered the first question, I mean, I talked about the fact that it will address the demand pull inflation, or at least that aspect of it. But bear in mind that there's the demand pull, there's the cost push / supply shocks that are also driving inflation in Nigeria. So yes, it would mop up liquidity because, for instance, that 32.5%. So let's assume that total deposits in the banking industry is about 100 trillion naira, using that as an analogy. So that 32.5%, that means you're mopping up 32.5 trillion naira, which will be kept as interest-free assets with the central bank. So the banks can't trade or do business with that amount of funds. So you're mopping up liquidity. But again, the fundamental factors driving inflation in Nigeria, one, the spillover effect of COVID. I mean, most countries and Nigeria were yet to recover from that. Then the Russia-Ukraine war with the increase in commodity prices, the energy crisis, we have supply chain disruptions, energy prices. So all these have led to an increase in cost push factors. Even take, for instance, fertilizer now, because Russia is one of the largest producing countries of fertilizer globally, that definitely is going to affect agricultural output. So even despite the fact that we're in the harvest season and we expect to see, an increase in supply, which should lead to a decline in commodity prices, because farm inputs like fertilizers are still high, they would affect inflation. Also, more importantly, is the exchange rate pass-through effect, which I guess, again, this is where the CBN too is trying to address two major challenges that the economy is facing, inflation and exchange rate. Because by mopping up liquidity, to an extent, you're also restricting the demand for forex. So by so doing that, a lot of banks and a lot of customers may not be able to demand for as much. And that way, it should maybe to an extent address the forex issues. But that is not going to be sufficient because, again, even as inflation, there are structural and fundamental issues. The exchange rate dynamics in Nigeria too goes beyond what the increase in interest rates is going to address, because there's the supply shocks, there's the arbitrage issues that are driving speculative activities, the policy uncertainty, and supply sources that we're seeing decline. So the CBN has to do much more than increasing interest rates to be able to address the objectives, to be able to address and mitigate the challenges which we are seeing in the country, which are predominantly inflation and exchange rate weakness. And I like the fact that Boason also mentioned the fact that Nigeria is not alone. I mean, look at Ghana. Ghana is experiencing these same issues. Even beyond inflation and currency weakness, there's also the issue of debt, which even brings me to the point of the securitization, the ways and means advances. So the federal government's borrowings from the CBN. If you look at it now, what has been done, the CBN is mopping up liquidity, but then we still have those ways and means advances there. So that definitely alone is about 20 trillion naira. So on one hand, you're mopping up liquidity. So are you mopping up liquidity from the banks in order to be able to fund or support or address or accommodate the increase in the ways and means advances? Because if that is so, then at the end of the day, you're just nailing the banks and nailing the books, and the effect is going to be zero. So I think that is something that we need to look into, because on one hand, yes, you're mopping up liquidity, but there are still other sources of that are going to boost liquidity in the system, especially the government's borrowings from the CBN. And that would definitely negate the impact of this tightening that we have seen recently.
Thanks, Dami. Boason, let me come to you. There's a quote from Taiwo Oyedele, who's the head of PwC, Corporate Advisory Services, where he says the MPC urgently needs to address the Naira's downward spiral with appropriate policy interventions to improve exports, harmonize rates, and promote import substitution. I'm not sure how many of these fall under the purview of the MPC, but what do you make of these comments there?
The central bank is trying to move the needle. You remember the central bank ran into some hot waters, as it were, with the customs and a few others when it came with this guidelines, as it were, regarding export proceeds and things like that. Yeah. And they said, no, the central bank has no right to set parameters and all that. The central bank is fighting too many wars, too many battles across the divide, because the fiscal authority had practically gone comatose. Let's be very clear and stop the front. The World Bank have said a couple of things in the last few days. The economy is bleeding. We're not getting both local and foreign investment. Capital formation is not happening. So the government is short, as it were. So the central bank and the MPC is those folks are holding the short end of the stick. Yeah. So you need to improve exports. For example, airlines are coming to Nigeria and they're leaving empty. Vessels are coming to Nigeria, they're leaving empty because they have no goods or exports to really take away from Nigeria. Again, to get into the ports and out of it is like a camel passing through the needle's eye. So either way, there are corruption and a lot of unwholesome practices, both at the airports and the seaports in terms of export. So it's not anybody's paradise right now as far as exports is concerned. So we need to do a whole lot of things. You heard what the central bank, the communique, just said, look, the government needs to further improve ease of doing business. That's a very nice way of the central bank and the MPC putting it to the government that, look, the ease of doing business is not easy at all. Right. You need to help me here. That is the message he sent when he said that you need to further ease the ease of doing business, because there's no ease in it. And I get online, you see on the news, some estimate, allegations about 220 bribery-taking ports or stops between before you get to the port, within Lagos alone. And everybody's on the take. Now, how much would you put in your pocket to be able to ease Naira as an export, to grease palms and get onto the... So the whole process is really, really wacky, as it were. We're not moving the needle when it comes to... I think ease of doing business has practically gone to sleep. Right. We need to raise this up. We need to raise those level of import export that we can get, so that we can get the FX. The central bank is trying to put these incentives out. If you do export or whatever, you get to get this rebate. The central bank is trying to move that. But the real fiscal authorities, the government, the MDAs, the ministry, departments and agencies responsible for investment, for trade, for industries, for customs and whatever, they are not helping the central bank. And that is where we need to see something very tangible, critical change happen. If it cannot happen between now and May 29 next year, it should happen as early as the 1st of June 2023 under a new administration. Until we get that, look, the central bank, this current central bank governor, his term will run out in about a year and a few months or thereabout from now. We're going to be back still dealing with these MDAs that are not helping the government at all. Not to talk of leakages in terms of revenue they've been able to collect. So we've got a whole lot of problem on our hands that would have helped us resolve, tame inflation a little bit and help the exchange rate management to get a little bit better. But there's a little leeway for the central bank to deal with. So what does it have to do? Well, recall the naira that is on the streets and the banking system. And now, 3 days ago, the government just said it wants a set of promissory notes to pay a number of states, governments for those who constructed roads and what have you. Then they've asked the National Assembly or the Senate to approve that. So the central bank is torn between the banking system and the economy and his paymasters. On the other hand, because they need to survive between now and the end of this administration. So it's a very tough tightrope for Godwin Emefiele right now, and I don't envy him.
Thank you for that, Boason. Bode, what's your take on, I guess, if you want to touch on exchange rate unification or Taiwo or Yedele's comments or anything else that you've heard Boason just talk about?
Well, definitely to be a winner in the environment we're in, you have to be a manufacturing and export hub. There's no way around it. And you have to have strong ease of doing business factors to support attracting investments. It's just not enough to just dangle good rates and a good environment just based on the central bank policies. So just like Boason said, I think much more has to be done on the fiscal side. The other thing that I observed just today, I think it was the World Bank, they came out with a paper, although they were looking at the Asian economies, they pointed at a trend that we're likely to be seeing in the post-COVID environment, especially with these interventions. And interventions are also a source of policy-induced distortions if one isn't careful. And although the central bank alluded to it, that they are now going to be fading somewhat so that the fiscal side can take care of these interventions, it's important to be sure that these interventions are not inflationary. And one thing that the World Bank is drawing attention to is that many zombie companies are getting a lot of support. These are companies that would ordinarily be dead if they had not been COVID, or if they had been COVID. So if COVID was really not the issue, but these are companies that really shouldn't be getting this support at all, but they are getting a lot of support in many emerging economies. And that is crowding out funds that should be going to more productive sectors. It's also resulting in an inflationary effect. So clearly that has to be looked at. The other thing is debt, government debt. Apart from the fact that it is worrisome from the perspective of higher interest rates, the hiking of rates that we're seeing in the West, and the issues around the strong dollar, also making debt a bit of a nightmare for many economies like Nigeria. The fact is that many of these government debts results in privileged access to domestic savings, which also crowd out more productive private investment and hurt growth. So you'll be surprised how much of government debt is taken from sources that really should be the private sector. So those are issues that the central bank is looking at if they want to get productivity at the level at which it's in. And my concern is there's a lot of effort that the central bank is putting in, no doubt. But in terms of the results, I would look at things like the PMI. I'm looking at the results in terms of the GDP growth, in terms of employment, in terms of jobs added. I'm not seeing it there, and I think there's a disconnect because of some of these portions that are there that they are not as sensitive to as they should. But clearly, this MPC is focused on inflation. Like I said, it's a narrow dive to throw everything, the sink and everything at inflation, which perhaps is good, given the fact that politicians, you know how they are. They're about to go crazy with money, and you just need to be sure that they have none distort your economy. But I think the fiscal side and other sides of the economy, Minister of Finance, they really need to come together and have a plan to be able to address some of these wider issues.
All right, we will leave it there. Thank you so much to the panel. Arise business analyst Bode Ososami in the UK, the host of the Arise Xchange, Boason Omofaye, right here with me in Lagos, and of course, Damilola Akinbami, Senior Manager, Clients and Industries with Deloitte. Thank you three so much for joining us to talk about this MPC decision. Appreciate your time.